Hello and welcome to ChooseFI. Today on the show, we have our good friend Brian Feroldi back on to talk about the 2025 state of the stock market. Brian is our most frequent guest in the history of ChooseFI, and he's the one I go to whenever I have questions about the stock market, about investing, especially with individual stock investing. It goes back to the very early days of ChooseFI, and Brian has opened our eyes in so many ways. He's so intelligent, he's so well-researched, and he's just a wonderful guest. I think you're really going to enjoy this. And with that, welcome to ChooseFI. Brian, always good to see you, my friend. How's it going?
Brad, great to be back. Thank you for having me, my friend.
Yeah, you bet. You bet. So, okay, I think we should kick off. Obviously, this is going to be the 2025 state of the stock market, but let's do a little look back. So let's talk about a review of 2024.
Yeah, well, for all the financial nerds that are listening to this, I'm sure that everybody just updated their financial net worth statement in early January. And if those people had money in the stock market, it's likely that they had a big smile on their face because 2024 was another great year for investors. The large cap index funds, namely the S&P 500, finished the year up 25%. And in 2023, it was up 26%. So 20% plus return years in a row, that can do wonderful things for your net worth.
Yeah, ever so slightly, right? That's not a bad thing at all. Can you give us a sense historically of how anomalous is a 25% increase? Is that something we see fairly often? Like, just for people who have no sense of this, how regular is that?
So if you look back at the long-term history of, let's say, the S&P 500, the term that always gets quoted is a 10% annualized return. That's about what people can expect if they invest in the U.S. stock market for long periods of time. However, that number is a little bit misleading because it's actually quite rare that the market actually returns about 10% in any given year. It tends to overshoot that number and then undershoot that number year by year. So 20% returns are not something that happen frequently, but they're not all that uncommon either. In fact, in the last 10 years, the S&P 500 has returned 20%. Let's see, 1, 2, 3, 4. This is the fifth time in the last 10 years that the S&P 500 has returned more than 20% in the calendar period.
Wow. Yeah, that is remarkable. And yeah, it's interesting. I think in the FI community, we generally use the back of the envelope 8% number as an expected annual return. You said 10% is kind of the back of the envelope for S&P over a long term. So that's kind of more what we use for our calculations. But as you said, it's very fleetingly rare. The return is 8 to 10%. There are some years where it'll be down. There are some years, obviously, where it'll be up 20, 25%. And I think that's hard for people to wrap their minds around, Brian. I think especially when they're used to things like a high yield savings account that just spits off a certain amount of income every month. How do you counsel people to think about stock market returns and volatility versus risk?
Well, this always gets back to what you and Jonathan have been preaching forever, which is the investor policy statement. And really, when anybody is going to make an investment in the market, the very first question to ask yourself is, when do I need this investment to pay off? This is such a critical question that so many people overlook when they're making an investment. If the answer is any time period less than 5 years, I don't think the stock market is the place that you should put that capital, even if the market is looking quite enticing or you're very excited about the market. Because simply put, in over periods that are less than 5 years, the returns that you earn from the market are not predictable enough. So if you know that you have like a down payment you want to make on a house, or you have kids that are going off to college, so if you know that you need to spend that money in the next 5 years, I don't tell people to put it in the market. However, if you're putting money into the market to pay for things like a FI lifestyle or a long-term retirement, or if you're agnostic as to when the returns come, like if you have enough flexibility in your life that the returns could come in year 2 or year 7 or year 13, and you can handle that kind of variability, then you can put money into the market.
Yeah, I like that. So 5 years is your kind of line of demarcation in essence. If it's sub 5 years, like you said, maybe the stock market isn't exactly for you. And obviously, we're not giving advice to anybody, let's be clear, but we can't give blanket advice to hundreds of thousands of people on a podcast and with any type of specificity. So that's just Brian's back of the envelope. But I think that's probably a good thing for you to consider. And it's funny, Brian, because we were actually talking about buying versus renting houses before we hit record. And I think that's actually kind of the time period that I consider for that as well. It's interesting, like what we all consider short versus medium versus long term. I know I would not buy a house if I was certain or nearly certain I was going to live there for fewer than 5 years. And it's interesting that you think the same for the stock market, because as we know, there's volatility. And if people are expecting that 8 to 10% return every year, it's just not the way of the world. It doesn't work that way, simply.
Yeah, you're setting yourself up for disappointment. I mean, investing is always an expectations game. It's what the asset is going to return in comparison to what you expect it to return. Investors can get in trouble when those two things are way out of whack.
So just one last piece on the look back at 2024. So we talked about S&P 500 being up 25%. I'm curious if we dove into that number or if we dove into different sectors or such. Is this a question of a handful of companies or a couple dozen companies that drove most of the return? Is this a broad economy-wide increase? Like how do you think about that?
So, as a general statement, the market returns are almost always driven by the largest components. Most people understand that the major indices, such as the S&P 500, are market cap weighted, meaning the larger a business is, the more influence that it has on the returns of the stock market and vice versa. So while there might be 500 stocks in the S&P 500, a minority of those companies, the top 10, drive the majority of the return. And that's one thing that's actually really interesting about today's market. I think most people have heard of the Magnificent Seven, those so-called seven major, massive tech companies with multi-trillion-dollar valuations. Those companies are Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. Well, all seven of those companies had stellar 2024 performances. The worst performer of that group was Microsoft at 12%, and the best performer was NVIDIA at plus 171% in 2024. So actually, what's interesting about that huge outperformance by the largest of the large companies is that if you look at the top 10 stocks in the S&P 500 at the end of 2024, just those top 10 stocks represent 39% of the total value of the index. And that is actually an all-time high.
Wow. Is there any type of takeaway here for a FI investor who's thinking about investing in individual stocks? I know you famously were the one who brought that concept to us because we've long talked about, and it sounds so obvious and self-explanatory now, but we've long talked about mutual funds and ETFs, and obviously you do as well, let's be clear. But is there some takeaway for someone, both either positive or negative, of, hey, this is something you should do, or maybe it speaks to, hey, this might be too difficult for the average investor? Like, I'm curious, I know this is a very broad, nebulous question, but any kind of takeaways from someone who's looking to invest in individual stocks?
Well, if you look back historically at, say, like the last 30 years, again, it's normal for the largest companies in an index to make up a very large component of the index. But today's concentration in those top names is something that we've almost never seen before. And that, by definition, means that the returns of the market moving forward are going to be disproportionately impacted by the returns of essentially those top 10 biggest companies. Now, those top 10 biggest companies, many of which I just mentioned before, are just stellar businesses, perhaps the greatest businesses that have ever been created. And if you look at the fundamentals of those companies, they're all growing strongly. They're all buying back stock or paying dividends. They all have huge opportunities ahead. Almost all of them are benefiting from the buzzword of the day, which is artificial intelligence. So there is reason to be optimistic about the long-term potential or the 10-year potential of those companies. However, if you've studied markets for long periods of time, you know that there is always a number of companies that are leading the index, and capitalism is quite brutal and quite unforgiving. So if you rewind the clock to the biggest, most dominant companies 20 years ago, only a handful of them would actually still be around and relevant today.
Huh. Yeah, that's incredible. That was my next question because I'm certain I always try to put myself in the mind of the listener. Okay, Brian's sitting here saying the top 10 or 15 companies drive most of the returns. So shouldn't I just invest in the top 10 or 15 companies? But how you just ended that clearly suggests, hey, that's not the slam dunk you might be thinking just by hearing this as like a blink kind of reflex response.
Right. Well, let's rewind the clock to the year 2000. I'm going to list off some of the largest companies that existed in 2000. And just like today, these companies effectively looked invincible. They just look like dominant, massive winners. So the top companies in the year 2000 were Microsoft. Hey, they're still around doing their thing. But then there's General Electric, Cisco Systems, ExxonMobil, Intel, Citigroup, IBM, Oracle, Merck, Coca-Cola, and AIG. Now, if you know anything about the last 25 years of returns for those particular stocks, many of them have been absolute train wrecks for investors. General Electric has been awful. AIG was effectively wiped out in 2008. ExxonMobil has been a go nowhere stock. Intel is in turnaround mode, and they have drastically missed out on the uptick in AI chips. Citigroup was also effectively wiped out in the 2008 financial crisis. Cisco Systems is a shell of its former self. So again, these were the strongest businesses in the world, nearly invincible 25 years ago. And today, many of them have provided investors with long-term returns that have been horrific.
Yeah, it's sobering to see that. And I think this speaks to me personally. And again, everyone has their own judgment in terms of how they invest. Let's be entirely clear. But I think this is why mutual fund and ETF investing, broad-based index funds really appeal to me so greatly that the beautiful part is I don't need to think about it. It's self-cleansing. You have a little piece of all of this. I think to me, and we can never know the future, Brian, obviously. But to me, this gives me the highest likelihood of success over the only term that matters for me, which is the long term. That's where my mind is. Of course, just like anything, strong convictions loosely held. That is what I believe today. That doesn't preclude me from changing my mind on investing sometime in the future. But nothing has so far gotten to that level where it's made me second guess that. So, I mean, for anyone out there listening who's curious what I invest in, the vast majority of my wealth is in VTI and VTSAX essentially. And I'm not beholden to Vanguard, let's be clear, but I think having broad-based S&P 500 total stock market index funds, that's where I choose to invest essentially all of my net worth. I do have, as you know, Brian, a decent bit of Berkshire Hathaway stock and a little bit of Markel. So I don't want to say here that I have no individual stocks, but really the vast majority is in VTI at this point.
Yeah, and I think that is the correct thing for the vast majority of investors to do. However, I do think it's important that if that is your strategy, you just have to be aware that markets move in cycles. And generally speaking, when large cap stocks perform very well for long periods of time, which they have for essentially the last 16 years, it is not uncommon from a market historic perspective for then those stocks to underperform or revert to their have a mean reversion feature of them over the next 15 years. In fact, if you look back at the year 2009, essentially from 2000 to 2009 was a period of net negative returns for large cap stocks. So while the last 15 years have been sensational and large cap stocks have been the place to be, there have been plenty of periods historically where large cap stocks delivered substandard returns for their investors. In fact, famed investor Howard Marks, who's one of my favorite market commentators to read, recently put out a memo where he noted that with the valuation of the S&P 500 where it is today, and the S&P 500 has similar dynamics to it as a Vanguard total stock market index. He says that historically over the last 30 years, when the S&P 500 had reached levels that it's at today from a valuation perspective, the future returns, the 10-year returns of the market essentially net out to zero for a 10-year period. So he wasn't predicting that that was going to happen, but he did point out that we've seen this before, and the net 10-year returns for investors from these levels have not been good.
Yeah, I mean, that is, it's certainly sobering. And again, I'm using that word twice in a 5-minute span here, but this is important. I think this is the perfect launching off point for the 2025 state of the stock market, right? Because it is interesting when you think about it, Brian. I mean, if you're talking the last 15 years, the returns have been stellar in the stock market, you've got a 40-year-old person who maybe started investing at 25 and they've known nothing but good years. I mean, that's a significant, that's a generation or two, maybe, right? And you have a lot of people who have, except for the tiny little, obviously we had the very short-lived COVID drop. There are always periods where the stock market goes down. But in totality, 15 years of essentially nothing but up. That, I think we go back to that investor policy statement you talked about a couple of minutes ago. I think we all need to get our heads right, because you simply don't know what the future brings. But yeah, you listen to someone like Howard Marks and you'd be a fool to ignore that.
Yeah, I think that that's right. And again, the takeaway for me when I read his memos and I'm like Valuations today isn't Chicken Little, isn't the sky is falling, isn't I need to do a wholesale change. But perhaps a takeaway is to be even more conservative with your assumptions about returns that you can get from the stock market moving forward. And even perhaps to consider putting a larger portion of your portfolio into fixed income, so the bonds. And I will once again reference people to that wonderful episode that you did a few years ago with Frank Vasquez on the bonds, which to me is something that I re-listen to annually.
Yeah, and Brian, that's episode 194 with Frank Vasquez. It's the role of bonds in a portfolio. And yeah, I know a lot of people consider that one of our absolutely best episodes. So yeah, it's nice to hear that you go back and listen to that so often. So, Brian, you talked about valuations, and I know that's something you've done some study on. So I'm curious, again, 2025 state of the stock market, where are we with valuations?
Yeah, so every 90 days, JP Morgan Asset Management actually puts out this wonderful presentation that is an updated state of the stock market. So a lot of the charts that I'm going to be referencing or the data that I'm going to be referencing is actually pulled from that. So in there, they have a wonderful visual which shows the S&P 500's forward price to earnings ratio. I think many people listening understand what the price to earnings ratio is, but that word forward might give them a little bit of raise an eyebrow. So what this is it's the current value of the S&P 500 divided by next year's estimated earnings per share. So the S&P 500, like all markets, are forward-looking mechanisms. They're always looking to the future, and specifically the near-term future, to figure out where valuations can be. So JP Morgan has this wonderful 30-year chart that shows the forward price-to-earnings ratio of the S&P 500, and then they put some simple standard deviation bars on there. And these can be used as a very rough proxy for, is the market expensive right now or is the market cheap right now? So the 30-year average for the S&P 500's forward price to earnings ratio is right around 17. Now, of course, there's periods when it's significantly above that number and significantly below that number, but that's still the long-term average as a benchmark. Well, as of the end of 2024, according to JP Morgan, this number was 21.5. So effectively more than one standard deviation above its long-term average. And unfortunately, if you look at the last two times that this number was above, one standard deviation above its long-term average, well, the most recent one was 2020 and 2021. And I certainly have the scars of 2022 drilled into my head. And then the last time it was above that number or this high was 1998 through 2000, which again was the peak of the market. So again, looking back at recent history, 30-year history, valuations today are roughly in line with the last two market highs.
Okay. So, Brian, I certainly get that, and obviously the historical reference, but ultimately, I think what we're all asking is, what does this actually mean based on, the only thing we care about, which is our own future returns, essentially?
Yeah. So again, JP Morgan has they have a scatter plot chart on here, which shows, okay, when valuations are at these levels, what are the returns that investors get moving forward basis? And they actually have it on a 1-year basis, 5-year basis, and a 10-year basis. So on a forward 1-year basis, the returns are actually all over the map. And that would be exactly what you would expect. Just because markets have gone up recently or valuations are high, that's actually a pretty poor predictor about what they're going to do over the next 12 months. The next 12-month returns of the market are always effectively random. However, if you look at longer term time periods, so 5-year and 10-year periods, that's when they become a little bit more predictable. And if you look at the 5-year returns at valuation levels that are similar to where they are today, there is an inverse correlation between starting valuation and future returns. The lower the starting valuation, the higher the future returns are, and the higher the starting valuation, the lower long-term returns are. So based on JP Morgan's data, it looks like low single-digit 5-year returns are about what the markets have done historically. But if you zoom that out to a 10-year period, which is, I would argue, is even more accurate data, the return expectations goes effectively towards zero with a slight deviation up or down. So again, I think the takeaway for this is if you're going to be investing from today and you have a long-term time horizon, it's reasonable to pull back on the expectations that you have for the market. You mentioned previously that investors tend to use an 8% return as a rough guide. The prudent thing to do for long-term projections of your net worth might be to pull that back even more.
Okay. So pull back on expectations is what we're saying here. And I guess, Brian, I'm curious. So you mentioned AI before. And obviously, we can never know the future, right? And I kind of hate the whole prognosticating game, frankly, of like the financial media porn of, oh, is it going to go up? Is it going to go down? I ultimately, we have no idea. But for someone who's sitting there saying, okay, look, I get what Brian's saying. I get the history, but it feels like we're at an inflection point with where humanity can go. Do you have any thoughts? I don't mean specifically on AI necessarily, but for somebody who's sitting there saying like, okay, do I just look at history and say, all right, there's a reasonably high likelihood that my returns are going to be sub what I might have expected a couple of years ago versus, oh, wow, maybe this time is different. And I always hesitate to ask that question, but I'm curious, nevertheless, your thoughts.
Yeah, so the data that we've presented is by its nature, backward looking. Based on history, when this has happened in the market, here is a set of things that have happened in the future that you can use to guide your expectations. But to your point, I don't want to come on here and pretend to be Mr. Doom and Gloom. Like for the record, 90% of my net worth is still in the stock market as of today. And I expect it to be have a heavy dose of stock market exposure essentially indefinitely. But there are reasons, potential reasons to believe that returns in the future might be higher than they have been historically based on what you just said. Given all the disruptions that are going on in the world right now, from an artificial intelligence perspective, from a biotechnology perspective, from a robotics perspective, from a clean energy perspective, to say nothing of Elon and Doge coming into office and potentially getting rid of lots of regulations, which could, in theory, open up, grow our economy faster. All those things are certainly possible. And markets are nothing but forward-looking discounting instruments. So there are legitimate reasons to believe that, well, perhaps earnings growth or profit growth over the next couple of years might be higher than they have been during more historic periods because of everything that we just mentioned. And if that is the case, then perhaps valuations today are justified given that stronger growth might be coming.
Yeah, it's an interesting case. And obviously we don't know, but I think we all just need to just think broadly, keep aware. I think that's all we can do, Brian, at the end of the day, right? Like we just have to try to stay on top of this. That's why we have amazing guests like you come on the podcast and talk through this stuff, because anytime, and I'm talking for the financial independence community here, I think we are the most adept thinkers and people who understand the world and understand that things change all the time. So I never want to be monolithic about anything like we only invest in the total stock market index fund. Like, no, that's not how the world works. You have to always update your thinking. I think that's a really important intellectual exercise, but I think also it helps you stay nimble for opportunities. Like that, Brian, that's a beautiful aspect of life is things are constantly changing. I feel like the FI community specifically, like we're always on top of, hey, how can we maximize this new rule or whatever it may be? Like we find ways, and I think it's really interesting. So I guess I'm curious, so we're recording this in the beginning of January of 2025. I know you said 90% of your net worth is still in equities. Are you contemplating or are you taking action on changing anything in your portfolio? I know we've talked previously how you think through your own portfolio construction. Can you give a quick overview of that for someone who probably hasn't listened to that episode and maybe how you're thinking about it now?
Sure. So, to give you a high level overview, my personal portfolio, my equity portfolio, is a combination of index funds, broad based index funds, such as Vanguard Total Stock Market Index Funds, Emerging Market Stock Market Index Funds, and effectively my retirement accounts are 100% index funds. Beyond that, my cash, my taxable account, that is 100% individual stocks. And I am a by and large, long-term buy and hold quality investors. So I log into my brokerage account 2 to 3 times per year and add or subtract individual stocks from them. So I am quote unquote active with that portion of my portfolio, or at least more active than I would be if I was just purely a passive investor. And I can say from my perspective, I do monitor the valuations of the companies that I hold. And actually, what 2022 taught me is that I should monitor the valuations of the stocks that I hold more closely, especially when there are big macro changes going on in the world. So I can say for myself that I am at a record high cash balance in my individual stock portfolio. I'm currently about 15% cash, which for me is on the higher side. And I could actually see taking that number higher over the next month or two, given where valuations are, with the hope to be able to redeploy that capital at more favorable valuations if some of my favorite investments went on sale. But again, that is what I choose to do with my money, and I'm more comfortable with being a little bit more active with valuations where they are. But if you're just a passive investor who just wants to essentially set it up once and buy in and forget, that strategy is still valid today.
Yeah, and I would echo that. I personally am not changing as of this moment. I have not thought about changing anything in my own equity portfolio, nor putting additional money in. I'm continuing to do that month after month, essentially year after year. But that said, again, strong convictions loosely held, right? You can never say that I'm not going to change that. But as of right now, that's where I am. And yeah, I mean, I think we all just have to educate ourselves. I don't want to sound like a broken record here on the episode, Brian, but I think it's important. And I think anytime you stick your head in the sand and assume something's going to work forever, you have a rude awakening. Look back the top 10 companies in 2000, like you mentioned earlier, right? It's easy to think things will go on forever, and just the fact of history is it doesn't seem to work that way.
One thing, Brad, that you said earlier that I just want to echo and even reiterate is the ChooseFI community is probably the best positioned community out there for whatever is going to come our way. When you have a very high savings rate, when your expenses are quite low in comparison to your income, and when you can be, importantly, flexible with your investing strategy and with your spending strategy, I think that sets up the financial independence community to essentially thrive no matter what the markets throw at us. So even if the markets on a broad base return a very low number over the next, let's say, 10 years, that might be devastating to many people who are at or near retirement and they need strong returns to pay for their lifestyle moving forward. But if you're in the asset accumulation phase, or if you can simply be flexible with your spending patterns, what the market does over that time period won't impact you nearly as much as it would if you had a high expense lifestyle.
Totally agreed. I think savings rate to a large degree cures all. I know this is what I counsel my daughters is essentially if you have a 50% savings rate, and it's easy obviously for kids who haven't made mistakes and are just getting into life. But if you have a 50% savings rate, it's pretty darn hard to screw up your financial life. So I know I can speak from experience in making terrible investments and speculation in real estate and all this stuff. And by any measure, I've reached financial independence, and that's a really nice thing. So yeah, like Brian said, we are set up wonderfully. So Brian, I wanted to go back to the state of the stock market. So we talked before about these largest companies, right? Certainly the seven, but I expect it extends a little beyond that. Are people rightly concerned about market concentration? If this is something that's flittered through their mind, or they read it on a CNBC article or something like, hey, the top 15 companies make up X percent, 30, 40, whatever, you said earlier. Is this something that is just kind of par for the course in terms of stock market? Is this something that we are at a historical anomaly? Is this something that you're concerned about? I just love to hear your thoughts generally.
Well, again, it gets back to the fact that the companies that are the largest components of the stock market today, they are all effectively some of the best businesses that have ever been created. They effectively hold monopoly or monopoly-like positions in their market. They're all unbelievably profitable. Many of them are still led by their founder or at least a longtime executive. And all of them, nearly all of them, are taking advantage of AI, which is a huge investment today, but could turn into huge amounts of profit in the future. So the market is not stupid. The market recognizes and has awarded these companies huge market values because they're just excellent businesses. And it's also, you could also reason that given where we are with communication technology and how interconnected the world is, perhaps we can support multi-trillion or even multi-10 trillion dollar companies today, given how easy it is for communication to happen in between companies. Whereas in previous generations, that would have been just impossible to do. Moreover, these companies are also what's called asset light, meaning that they don't need a lot of physical infrastructure, big things to actually produce profits. Whereas again, companies of the past that have dominated did. So these businesses are excellent. And if you analyzed any of them on an individual basis, you can probably come up with a reason why the company is trading at the valuation that it is. So again, this is more of just something that I am aware of and I am thinking about, and some of the smartest money managers out there are raising as a potential issue. I don't think you should take action on it yet, but I do think it's something you should be aware of.
Yeah, fair enough. I'm smiling because I always like to needle you on Tesla, but obviously, the returns have proven you right to date. But we will see. I'm not the biggest Elon fan.
Any decade now, you'll be right.
To put it mildly, and it reeks of meme stock, but we will see. Any decade, that's awesome, Brian. Market share. Most investors have home country bias, right? I think we are no exception, but I think a lot of people who invest in US equities can say with a straight face, okay, maybe our home country bias makes a little more sense than if you were in Finland or England or wherever. That said, I'm curious how you think at this point in time about the US versus the world when it comes to investing.
Yeah, this is another interesting tell sign. Again, diving back to that JP Morgan asset market presentation, what they actually showed was that if you added up all of the value of all of the publicly traded companies in the world and then categorized them by what country are they located in, the United States effectively has 2/3 of the value of the entire stock market across the world. 2/3, despite the fact that effectively the US is 5% of the global population. Now, again, a big component of that is driven by these huge, massive, unbelievably successful companies that we've referenced many times. But on the flip side, because 2/3 of the market value is in the US, that means that the balance between market values in the United States versus internationally has shifted drastically towards the US. And again, if you look back historically at the dynamics between these functions, international stocks and US stocks tend to go in and out of fashion, where there are periods when the US dominates, like it has over the last 20 years now. And then there are other periods, such as like the 1970s, when international stocks really dominate. So there could be reason for investors to consider increasing their allocation to international markets if you are in the US, if you're seeking more diversification.
Okay. So seeking more diversification is ultimately is the point there. Because I think a lot of people, they might claim that, but they're just chasing returns, or they're just saying just something unsophisticated like, oh, the US has outperformed for X number of years, it has to revert to X, right? Like, how would you respond to somebody who says that just off the top of their head? Like, oh, the US has outperformed, it has to turn around eventually. Like, is that even a plausible thought? Or is it truly like a diversification play, like you're saying? I know that's a very broad question, but I'm just curious, like your quick hit thought.
Well, my quick hit thought is that you can actually get a decent amount of international exposure through the United States stocks. For example, take a company like Apple or Nike or McDonald's. Yes, they might be US companies that are listed in the US, but they actually get a pretty sizable portion of their revenue from international markets. So US companies, by their very nature, while their market cap might be associated with the United States, the companies behind them actually are more diversified geographically than you might naturally assume. But again, I always think it's useful useful to use history as a guide. History doesn't repeat itself, but it does rhyme. And if you look back over the decades, there are periods when international stocks go in and out of favor, just like there are periods when asset classes go in and out of favor. And as a general statement, things that outperform tend to go on to underperform, and things that underperform tend to go on to outperform. So again, I don't think you have to take an action based on the fact, but there's no doubt that the United States has been the dominant market and the best performing asset class for 15 years now. And it is possible that over the next 15 years, international stocks will have their time in the sun.
Yeah. Brian, we spent most of the episode talking about large caps and really these 7 stocks, et cetera. Brian, there are a lot of people who think about, okay, small cap or mid cap, like different options other than just, hey, these are the absolute largest companies. I'm curious how you think through that in terms of portfolio construction. I know, again, we've spent most of the episode talking about, hey, most of the return has been driven from these top companies. But again, like we just talked about with US versus the world, okay, sometimes certain segments overperform and there is some mean reversion. Is there any leg to stand on for somebody who's like, hey, maybe it's time to start looking at small cap?
Absolutely. If you look at, again, the last 10 years, the returns of large cap stocks, S&P 500, have been about 13% annualized basis. But if you look at small cap stocks, they've only been about 9% annualized. So that's a 4% delta, which doesn't sound like that big of a deal. But hopefully people that understand compound growth understand that over a long period of time, that can be a huge difference between the two. So again, there could be reasons for you to consider upping your allocation to parts of the market that have underperformed. So small caps are certainly in there. Mid caps are in there. We've already covered international stocks. Another component to perhaps consider would be real estate and real estate investment trusts, which are publicly traded companies that invest in real estate. REITs, as they're called, have only returned 5% on an annualized basis over the last 10 years. And they've had a rough go in the last couple of years, especially due to COVID, which just threw a major monkey wrench into big parts of the real estate markets, namely office space. So again, if your goal is diversification and to lower your risk that you have or to lower the concentration that you have in your portfolio to these mega cap companies, perhaps you should consider increasing your exposure to other parts of the market. So we talked about mid caps, small caps, international stocks, REITs, or heck, even fixed income.
Yeah. Brian, obviously this has not been a doom and gloom episode by any means, but I'm curious, are there reasons for optimism moving forward?
There are always reasons for optimism. And if you have a pessimistic mindset, you can find endless information to support that. And thankfully, the inverse is always true. So again, I'll point to that wonderful Howard Marks memo that he recently came out with. And he basically says, yes, valuations are high today, but they're not insane. Yes, the valuation of the Magnificent Seven is high, but they're incredible companies with realistic growth expectations ahead of them. Yes, valuations are high, but he doesn't see true signs of excess like we saw in, say, 1999, where people were saying there's no such thing as too high of a price for an excess at companies. And moreover, markets are highly priced today, but there are plenty of pockets in there that are not at extreme levels. Moreover, if you talk about the things that we talked about before, with potential deregulation coming, with AI, with robotics, with biotechnology, with all the disruptive innovation that's out there, I could see plenty of reasons to believe that growth moving forward could actually justify valuation. So like anything, there's always reasons to be optimistic. There's always reasons to be pessimistic. The investor's job is to keep both in their mind at the same time and not go crazy.
Yeah, isn't that amazing how confirmation bias works, right? Like if you are looking for reasons for anything in life, you pretty much can find it. But as Brian just described, it's about being intellectually open and curious. And there is obviously skepticism. Anytime you get locked into anything, you need to be skeptical. You need to bring in new information, and you can hold competing ideas in your head at the same time. That's okay, right? It's often derisively called cognitive dissonance, as if it's always a bad thing. But frankly, we need to think about these things, and we have to be aware, and we have to look down the field of life, if you will, a 50-year field, and see, all right, what makes the most sense for us? And I think that really is a hallmark of the financial independence community. So, Brian, I'm curious, are there any closing thoughts, any other aspects of the market for 2025 you want to talk about?
My closing thought would be the same thing that it always is. No matter where you are as an investor, the first step is to educate yourself, understand any of the terms, and go and look up any of the terms that we said on the show that you did not understand. And perhaps you could even link to that JP Morgan report in the show notes for the podcast. But over the long term, the stock market has been a great place for investors to park capital. So I see no reason to believe that that shouldn't be the case moving forward.
Brian, I always love having you on. It's greatly appreciated, your expertise and your friendship to this whole community. So thank you as always. Where is the best place for people to find you or to reach out?
Yep. So as a general statement, if there's a social platform that you like, I'm on it. So just type in my name, Brian Feroldi, and you can find and interact with my content.
Wonderful. Brian, thanks again.
Thank you for having me, Brad. Always awesome to be here.